cross-border payments are the problem, as we've heard, where the case is more compelling. But even there, I don't think that distributed ledger technology, which is what a lot of people talk about, is a solution. There are already innovations that are significantly bringing down the cost of cross-border payments in cases where there are banks at each end. So we heard those figures of 6% and 10%, 6% for cross-border bank intermediated payments. Those costs are coming way down already as a result of the kind of technology that Ripple has deployed and that Santander has therefore adopted. So I think there is an issue for people who don't have access to a bank on each end, but not for the rest of us. And even if you don't have access to a bank on each end, one can imagine the use of distributed ledger technology to make that transfer secure without having to pay exorbitant fees to Western Union or whatever. But there again, I think there are immediate money laundering and terrorist finance concerns that can be that remain an obstacle and remain unresolved. So
Welcome to all our participants, to our fellows and friends of CEPR, to this webinar. This is something new. We are going virtual. We want to try much more virtual meetings in the future, and this is actually in many ways a pioneer. And I hope so that you also have this feeling of pioneer status here. CEPR, is an organization that organizes many meetings, and usually these involve travel. But for many reasons, ecological, economical, but also health these days, so much travel and meeting in the future will no longer or should no longer be always physical. And therefore, thanks to technology, we should be able to have meaningful interactions in the future more in the virtual space. So I'm sitting here in Geneva at the Graduate Institute with Cédric Tille, and there is Antonio Fatás in Singapore at INSEAD, and then we have our great panelists, which Cédric will introduce a little bit later. But the gist is we are between Boston, Berkeley, Singapore, Geneva, and Basel, really covering a good part of the world, and that is the kind of interaction that we would like to have here is, however, the same type of interaction as we would have in an intimate type of workshop, namely a very open discussion, a very open-minded discussion about a very topical issue, namely digital currencies, and in particular, where do we stand, where are we going, and what central banks can do. I will leave it at this for the moment and hand over to Antonio Fatás, who is running the Research Policy Network on Digital Currencies for CEPR, and who will say a few words of introduction. Antonio, over to you.
Thank you, Beatrice. It's great to have participants and panelists from all over the world having a discussion on a topic which is very current, the issue of digital money and also the role of central banks. I've been heading the Research and Policy Network at CEPR on fintech and digital currencies. This is a topic that I think has become interesting over the last years. And it doesn't quite fit in one particular field of economics. So there's people coming from macroeconomics, from microeconomics, from finance, from regulation, and many other areas interested in the topic. So the idea of creating a research and policy network within CEPR was to put together a group of researchers, which is about 30 plus. We started about in 2018, it's almost 2 years ago. And the idea is to generate a set of conferences, meetings, and also publications to try to share with others some of our thoughts. Since we launched the network, there was an initial publication, which is an ebook that you can all find at the Vox EU portal. Later, we organized a conference at the BIS in Switzerland back in September. And then we started a few months ago a debate on the issue of Libra and other forms of private digital currencies. One of our panelists, Steve Cecchetti, and I were editing that debate also at the Vox EU portal. So all these things are things that are available at the Vox EU portal. The network is still going on, and this is a meeting where we're trying to go virtual as opposed to physical or as opposed to publications. And we hope we have a productive session today. I'll pass it over to Cédric. Thank you.
Thank you, Antonio. So my name is Cédric Tille. I'm a professor here at the Graduate Institute in Geneva, and I'd like to join Beatrice and Antonio and welcoming you all to this webinar. So I think it's a very interesting topic. It's a fast-moving topic. It seems that every week we have new aspects of digital currencies, their promises, but also the concern that they raise. We building new tools that may end up coming back and haunting us. So it's a very important topic to treat, especially at a place like the Graduate Institute. So we are a relatively small academic institution here in Geneva, but a very focused one. And especially our focus is twofold. It's on international aspects of various questions, economics, but not only, but also on policy relevance. So we're really interested in thinking of issues that will matter for policymakers, and digital currencies is clearly one of them. So I'm very happy that we could partner with CEPR in putting this an event together. What I'll do is I'll quickly introduce our various speakers. I'm very grateful that we could get 4 distinguished experts to take the time and exchange views. We start first is Steve Cecchetti of Brandeis University. So Steve, in addition of being an academic, is a very experienced policy maker with time spent at the New York Fed and at the Bank of International Settlements. Steve has written on the Vox debate platform that Antonio was mentioning, with a view of stressing the challenges and the risks that currencies such as Libra could entail. And I'm happy to welcome Tara Rice from the Bank of International Settlements, who's also been quite active on the topic. More notably, Tara co-authored the Geneva report on the world economy of last year. It was the 22nd edition. It's a document that is put together by the Center of International Monetary and Banking Issues here at the Graduate Institute. And the topic last year was on fintech opportunities and challenges from the new technologies in financial markets. Then we have Jean-Pierre Landau of Sciences Po, but also with a very strong experience as a policymaker at the Banque de France, for instance. And Jean-Pierre was recently commissioned by the French government to write an expert report on digital currencies, the challenges, and he's been actively presenting his findings over the last couple of weeks. And last but not least, we have Barry Eichengreen joining us from UC Berkeley. Barry is a well-known international macroeconomist. He was written on the challenges of digital currencies and what they could imply for the world, the international financial system. Is there a risk of dollarization going faster than we used to? And last but not least, I would like also to extend the thanks to Petra Bresova of CEPR, who's making this whole thing run smoothly. The format that we will have, we will start with each of the 4 panelists giving us a 10-minute discussion of what they view as the main issues and challenges. After that, Antonio and I will moderate the debate and raise some of the issues that were mentioned by the panelists or beyond, and have an active discussion. For the audience, you should have on your Zoom screen a part that says Q&A, so you can type in if you have questions that you'd like to be discussed, and we will see the questions that come up, and as moderator, we will make a selection and bring them to the floor. So with this, we can now go to our panelists who each speak for 10 minutes. And I propose Steve, if you want to start and give us your presentation.
Thank you very much. Thanks for that kind introduction, Cédric, and thank you for including me in what is a fascinating panel and an interesting subject. Let me just start with, you know, as an academic, somebody asks you about new forms of money. The first question is, what's money? And the simple thing I think that we have to think about is what's giving money value. And the answer that I have is that there are two things. One of them is I would call a custom, and that's widespread use and the fact that there's a network externality, the fact that when more people use it, it's worth more to everyone. The second is a legal basis, which I think is extremely important, and we always have to keep in mind that governments enforce debt repayment contracts and debt repayment in particular instruments, and they also require that debts with the government be settled in certain things. And in the current world, that's central bank money is the only thing for which that's the case. Now, just as an aside, I think it's important to keep in mind when we talk about digital and digital issues that digital money has been the norm for a very long time. Depending on what you look at, monetary, what we think of as monetary aggregates, if you look at the narrowest version of monetary base, which is the liabilities of the central bank, something like 60% of it's digital, and for M2, it's 90%. So most of us simply just don't use paper currency. Now, turning to what people refer to as cryptocurrencies, which is a form of privately issued money. First of all, obviously, they have no legal basis, and it's hard to overcome, as a consequence, the network externality and get people to use them. The legal basis jumpstarts the network externality. So the thing is also that, that there's an advantage, a distinct advantage when money is the liability of a trusted entity that has a strong incentive to maintain its value. So the question is, for cryptocurrencies, is always whose liability is this? Is the issuer trusted? And does the issuer have a long-run interest in sustaining the value of the liability? And also, what is the legal basis of this stuff? So I think that's a sort of by way of introduction. Let me turn to a few sort of technical things for a minute. First of all, on payments and the technology of using digital currencies in payments, obviously we see dramatic reductions in cost. There's some very clear limits, though, to how far the cost can be driven down. When we see inexpensive payment systems, very cheap ones, they're invariably connected to what are actually currently banks at either end. Just to give an example, I think remittances, cross-border payments are very important. These face significant costs that have remained stubbornly high in the face of improved technology. And we care deeply about these because the burden of these falls on the least well-off. Just to give you an example, the costs remain about 6% of the amount that's being transferred unless there's a bank at both ends. And that is the customers of the payments provider. In order to reduce the cost, though, the customers have to have banks at both ends. And the reason for this is that they're high compliance costs. So the reason it's cheap if you have banks, but not if you don't, is that someone has to establish identity. Someone has to make sure that this is not a transaction that is money laundering or terrorist finance or the like. And I think this is an extremely important thing to always keep in mind, is that there are huge transactions costs that arise from compliance with Financial Action Task Force regulations that prevent the use of finance for the facilitation of criminal activities. Thinking about banks themselves, I believe that open banking requirements, where individuals own and control their banking information, are likely to have a much bigger impact than new forms of money. but I'm still convinced that banks are going to adapt. It may not be the best example, but Monte dei Paschi di Siena has been a bank since 1472. It's obviously hit on hard times rather recently, but it still exists. And needless to say, the world has changed quite a lot since the Italian Renaissance. So the fundamentals of banking, though, don't seem to have changed, and the ability of banks to adapt is obviously quite important, and they're quite flexible. Now, so I'm not really worried about banks, but there is one thing that does worry me, and that is I want to talk for just a second about central bank money. I am sure that Jean-Pierre will speak about this a bit, but let me get in a word now. If central banks start issuing digital currency to retail customers, the world's going to change pretty dramatically. Very simply, the central bank would become a state bank. A significant fraction of retail deposits, in my view, would migrate to the central bank. The central bank issuance this is because the central bank is committed to issuing currency to meet demand. If it didn't do this, central bank money would not be convertible to commercial bank deposits at a 1-to-1 exchange rate. And if that were to happen, the world really would be different because there would be a scarcity of central bank money. So I think that given that central banks are committed to not letting their liabilities become scarce and drive up their price, then I think that they're going to have to issue as much as people want. They're also going to have to pay interest on retail deposits. Otherwise, they would have to stop paying interest on commercial bank deposits. And the most important part, however, is that central banks would have to verify the identity of all the holders of digital currency, meeting the know your customer rules and ensuring that money laundering wasn't occurring on their balance sheet. So this is going to be quite expensive, but the main thing is not just the expense, but the fact that so much activity will migrate to the balance sheet of the commercial bank. And as that happens, to the central bank from the commercial banks, then the question is, what assets will the central bank hold? Is it going to engage in private lending, or is it going to lend this money back to the commercial banking system? I think these are pretty serious questions, and ones that I think have to be answered before the central bank issues digital currency. To summarize, I don't see money changing much. Private issuers are very unlikely, in my view, to replace governments. Banks are going to adapt, and the only risk I see is that central banks decide to give individuals access to their balance sheets through retail universal central bank currency, and that, in my view, would be a pretty big disaster. I'll stop there. Thank you.
Thank you very much, Steve. Very interesting. We'll now go to our second panelist, and I propose that Tara Rice can give us her thoughts.
Thanks very much. And I'm very happy to be here. And it's always interesting to listen to Steve's thoughts and comments. So let me just start with one. He said that we don't use currency much anymore. But in fact, I'm sitting here in Switzerland where they just printed their brand new $1,000 notes. And we're doing some research on correspondent banking, and I'll get to that later. And I've discovered recently that 80% of $100 bills are actually held outside of the US. So currency use is declining, but there's still some pretty interesting use cases. So I am speaking on behalf of not the BIS, these are my own opinions, let me just say that. And I'm going to focus on the research that we did in the Geneva report on the world economy, where we looked at whether banking is disrupted in this era of financial intermediation. So I will second Steve in highlighting the current shortcomings in payments, particularly in cross-border payments. And at the BIS, we've been thinking quite a bit about this. So if you think about the decline in the banking relationships that we have cross-border, so we call it correspondent banking. It's a relationship between two banks in separate countries, and it's generally the most common way to send money. We've seen a decline in that in about 20% of relationships, and in terms of country-to-country pairs of about 10%. So we've got less bank interaction in the cross-border space, but yet trade is growing. Remittances, which is a very important source of income for many people in emerging markets, has been growing enormously. It's actually this year, the World Bank says it's on par to, or it's on track to pass FDI as far as the most important source of income in some developing economies in particular. But meanwhile, as Steve noted, the costs of cross-border payments are still quite high. 6% is the average, and in some areas like sub-Saharan Africa, it's as high as 10%. And so we've had 3 developments in the last few years. Think about the rise and the fall of Bitcoin and cryptocurrencies. We've then had big tech entry into finance. Think about Alipay and WeChat. And then this summer we had the Libra announcement. This kind of put a fire, it really put a fire under a bunch of policymakers' feet to realize and to think about what we can do to improve payment systems. So in line with this, in the Geneva report, we did a survey of banks, fintech, and non-bank firms, asking them what sorts of financial services and products were being most disrupted. We asked them across 10 financial products and services, including retail lending, back office processing, risk and compliance. I won't go through the whole list. But what was really surprising to us was that we asked these questions: what products and services are most affected right now by technology? Which ones are most affected right now by competitions? And which ones will be most affected by technology in the next 5 years? And the answer was payments across the board, really by a significant amount. And so the message we have is from the consumers is that the current payment system is not sufficient to us, and yet, and this is why, you could say, we are seeing the most dramatic changes in the payment space. We're seeing introduction of, like I said, Alipay, M-Pesa, Venmo, then we had Libra and Calibra and PayPal, and there's good reason for this. There are many advantages that non-banks can bring to the payment space. They've got the technology, they've got the user network, they've got size and scale and scope. But so consistent with what Steve said, there is still a space for banks here. They have experience with policy-based regulation. They know how to do data privacy and protection, and they have experience addressing sort of political and lobby issues. So I think we're at a turning point. Long story short, I think we're at a turning point where it's going to be up to the incumbent institutions, the banks, to really stand up to this challenge. It's going to be up to the public sector also to stand up to this challenge and improve their current payment systems, because the advent of private stablecoins or cryptocurrencies may be around the corner. So we've done some thinking about, enter the stablecoins into the market. What could be the impact here? We know the technology is there. We know the demand is there, and we know that the scale is there. So there is potential for these stablecoin arrangements to take off. So in thinking about this, and going back to what Steve had said earlier, there are a number of regulatory issues to address and to think about if we have a stablecoin arrangement that is competing with private or public money, central bank money. And that is legal certainty and sound governance, I think are the two most important things. That is, as Stephen said, does this really have, do these stablecoin arrangements really have a legal basis? In other words, are there rights for the users to redeem their stablecoins when they want to? Then there's also a number of concerns that have been raised regardless of size. There are issues regarding financial integrity, including anti-money laundering and CFT compliance issues. There's the safety and soundness of the payment systems. There's cybersecurity, data protection, and consumer protection. These are all issues that the central bank has typically been good at overseeing and providing, sort of providing as a public good. And so if we think about these stablecoin arrangements and what could be coming and how they could possibly be regulated, I think about things in three basic buckets. Whether or not these stablecoin arrangements could be considered a payment system, whether they could be considered a banking or deposit-taking institution, and whether or not they could be considered in the securities market regulation. So these are three buckets we think about things in terms of how they would fit, how they could possibly fit into regulation. But if we were to have a large arrangement, something that were to scale globally, then in fact, we would have many different frameworks, types of frameworks, and many different types of entities to address. And in fact, if you do think about what types of frameworks apply, it's really difficult to determine in the sense which ones are. And so you could think about the different functions, economic functions that stablecoins might engage in. So if they provide wallets, for example, the issuers, the exchanges, who governs it and who operates it. There's many different functions, and the question is really how they would be regulated. So to sum up, that was a lot of information. What we were thinking about generally is that we're coming at a time of change, and we're wondering if this time is different. We discussed this quite a bit in the Geneva report. Because the speed and the scale and the border hopping nature of technology is quite new, even though a lot of the fundamental and institutional features of banks that Steve talked about are quite old, centuries old, this time could be different. And so it's going to be important to think about sort of these regulatory issues ahead of time, because once a stablecoin feature could emerge, it could become very large very fast, so it could gain scale quite quickly. We see a couple of different situations for scenarios. One of them is just a status quo, in that the hurdles are just too high for stablecoins to develop. And another, Jean-Pierre may talk about it, is there could be digital currency areas. And then Mark Carney has talked about synthetic, as he calls it, hegemonic currency. So some combination of a private public sector currency could also develop. Let me just close with one other thing, and that is we talk about these types of digital money very vaguely, very generally. And in fact, there's quite a lot of distinctions to make, whether these are token-based or account-based. And even among potential CBDC or central bank digital currency arrangements, there's really a wide spectrum of what is being proposed and tried right now. For example, the pilot that was done in Uruguay on a CBDC was really quite account-based. It was a digital representation of a paper currency. So the serial number was basically digitized, and it was account-based rather than token-based. And there's a long discussion behind that, but I think it's important also just to really focus on the definition of each of these and what we're really talking about when it comes to digital money and how that could be designed, created, and issued. So I'll stop there. Thank you.
Thank you very much, Tara. We can now move to our third speaker, and Barry Eichengreen, who only has an audio feed, if I'm not mistaken. So Barry, I'll give you the floor.
Thank you and good morning. It's nice to hear such a high quality discussion of this subject, given that there are too many low quality discussions of new forms of money and digital currencies. Having heard two very good presentations leaves me less to talk about, although I can perhaps provide a slightly different, slightly more skeptical perspective on the issues that the two previous speakers raised, I am skeptical about the prospect for alternative forms of money. I'm skeptical about cryptocurrencies. I'm skeptical about stablecoins. There's an age skepticism gradient in this space, and I guess I'm one of the older participants in the discussion. It seems to me that history speaks very loudly on this question of new forms of money, that what we tend to see is relatively superficial changes on the margin in forms of money over fairly long periods of time. Steve mentioned the early Italian international banks, which pioneered the bill of exchange. I think that was a dramatic step forward 600 years ago, and there's been rather less progress since. That change which has occurred has tended to involve the centralization of the provision of money rather than the decentralization, which is what a lot of people in the crypto space tend to talk about. And I think there are two good reasons for that. Number one, national defense has become more expensive, and control of the printing press, to put it in very simple terms, has therefore become more important for the sovereign. And secondly, the efficiency advantages of having a single uniform form of money as opposed to various alternatives has become clearer as the economies have become more integrated and interdependent. What is the problem that these alternative forms of money, digital innovations, are supposed to solve? Inefficient local payment systems. That, of course, is not a problem in the 21st century. Many of us, most of us, enjoy access to relatively efficient local payment systems, and that includes, as we've already heard, people in, say, East Africa who don't have a bank account but have a cell phone and have access to M-Pesa and the like. Cross-border payments are the problem, as we've heard, where the case is more compelling. But even there, I don't think that distributed ledger technology, which is what a lot of people talk about, is a solution. There are already innovations that are significantly bringing down the cost of cross-border payments in cases where there are banks at each end. So we heard those figures of 6% and 10%, 6% for cross-border bank-intermediated payments. Those costs are coming way down already as a result of the kind of technology that Ripple has deployed and that Santander has therefore adopted. So I think there is an issue for people who don't have access to a bank on each end, but not for the rest of us. And even if you don't have access to a bank on each end, one can imagine the use of distributed ledger technology to make that transfer secure without having to pay exorbitant fees to Western Union or whatever. But there again, I think there are immediate money laundering and terrorist finance concerns that can be that remain an obstacle and remain unresolved. So in terms of the specific alternative forms of money that people have spoken about, we can, of course, immediately dismiss fiat cryptocurrencies like Bitcoin that do not provide the core functions of money. They're not a stable unit of account. They're not a store of value. they're good for gambling. I would argue we can dismiss stablecoins. That there's a lot of talk about them, but they either will not be stable or they will not be scaled. The literature on speculative attacks on pegged exchange rates. So the other schemes that involve full backing are simply too expensive, I think, to scale. They require someone to put up an actual dollar bill for every dollar's worth of the stablecoin that's issued. That will probably be less liquid and less reliable and less reputable. And finally, I'm skeptical that we will see fast movement in the direction of central bank digital currencies anytime soon. We've heard lots of nuanced discussion already on this call about the problems that will have to be solved before that happens. And I think those problems are formidable.
Okay, well, thanks a lot, Barry. That's very interesting. And we can now turn to our final panelist, Jean-Pierre Landau.
Yeah, it's a great privilege to participate to this discussion. So on the challenges that central banks are facing, what are they? I think there are two challenges. The first one is, of course, it has been mentioned by all speakers, a change in the forms of payments. And the second one is a potential currency competition, either from private providers on their own money area or from outside. To answer those challenges, I think I would assume that the central banks keep the same kind of objective function they have had regarding money over the last centuries, which is double. The first one is to preserve a competition in payments. And the second one is to preserve the singleness of money or the uniform currency. So they want several issuers and they want one money. That's what the central bank wants. For reasons that Barry mentioned, there's a seigniorage aspect, there's a public good aspect of money, but the efficiency dictates that there are several providers. So that is the kind of balance they've been trying to achieve all over the last 2 centuries, I would say. And the question is how that balance may be upset by technology and by technological progress, and more specifically by digitalization. So I will make a few comments both first on competition and second on the uniform currency. On competition, it's pretty clear that everybody, I think in the world, all the public authorities in the world are scratching their heads to adapt the competition policy on the new era of digital networks, and to balance the advantage of network externality with the many risks that they entail for competition. I think the BIS has produced a very nice chapter in their latest economic report last June. I think in Europe, we had a competition policy which was based on the assumption that only small players would come, like small fintech startup would come to put some competitive pressures on big banks. And we are now seeing, quite the contrary, we are seeing big tech, big overall technology company, which will compete with banks. So the outcome of that kind of competition will be largely dependent, I think, on what the regulators will do. I think Tara mentioned a few options, whether we'll treat those new competitors as a security issuer, as issuer of money market shares, as issuer of currency. I think the regulators have a large say in the matters, and it's not going to be an easy thing. You don't want to protect the payment business of banks too much, but you don't want to destabilize the banks too much as well. So a lot of conceptual work, in my view, has to be done on the proper competition in payments right now, and on the economics of payments, and how again to balance the positive externality effects with the negative competition effect, taking into account that payments, I think, will dominate financial intermediation in the next future, that payments will be the main point contact of financial customers with their financial institution. That's where the data will be collected. That's where the credit scoring will take its source. And so who will control payment will have a major sort of industrial power in the organization of financial intermediation. So I'm amazed that there are not more intense, I would say, research effort and conceptual effort to figure out what could be a very good competition policy for payments in the digital age. So that's the first, I think the first challenge that monetary and financial authorities had to face, and it's now, it's immediate. The second one is on the uniform currency. And as I think Steve clearly made clear, the whole thing rests upon the fact that all the private forms of money are convertible one-to-one into public form of money. And that needs an elastic supply of public money for everybody. Now, the only form of central bank money to which us, the general public, I mean the households and the corporates have access to, is currency, is cash. And cash is disappearing very fast, at least as a medium of exchange. Now, Tara mentioned a lot of statistics about cash and the fact that it's used more and more, but it's used more and more, if I'm not mistaken, as a store of value, but it's less and less used as a medium of exchange. And I think central banks are a little bit complacent on that, and that there are discontinuities in the technical evolution, which make cash shrink and disappear much faster than is currently anticipated. If I can mention a personal trauma, like 3 months ago in Newark Airport, Newark International Airport in New York, I was refused cash to pay for a $1.25 packet of chips. And the lady turned down my cash and she asked for a contactless card. That's one of the biggest international airports in the world. So and for a very small payment, less than $2. So I think we are witnessing a big shrinkage of cash in terms of medium of exchange, and that will only accelerate. As we know, there are cities like in Beijing or in other places of the world where cash is basically impossible now to use as a mean of payment. Now, what does it mean? It means that all the money that we'll use as general public will be privately issued, and that the convertibility of private into public money will remain totally theoretical, because there won't be any public money to convert into. And for me, this is the major argument for considering for the future the issuance of a central bank digital currency, because I have great difficulties figuring out what could be a financial system where only the banks have access to public money and not the general public and the corporates. I could elaborate on that, but I think it's going to be very difficult to, I mean, we are in totally uncharted territory. So for me, that's really the main argument for having a central bank digital currency, is to preserving the uniformity of the currency. Just to react to some of the remarks that Steve made at the beginning on that, it seems to me he assumed that the central bank digital currency would be account-based, that it would be an explicit liability of the central bank based on a deposit account that each of us will hold. But that does not need to be the case. We can have, just like now, a central bank currency which is token-based, and instead of having a physical token like the banknote, we can have a digital token, and it need not be attached to an account with an ID. And it may be exactly, if central bank wishes to do so, the central bank wishes to do so, it may be anonymous, it may be exchangeable peer-to-peer, and it may be an unlimited quantity if they wish to do so. But the system can be made very flexible. They can be in limited amount, they can be less anonymous. So I think these are these areas for research. And in a way, it forces us to really think of our social relationship with the currency. For instance, the question of anonymity has to be dealt with, and it's really a social question. I had a talk with a former colleague from a large central bank. I won't quote his or her name, but I was told, you know, this is a matter which is too important for the central banks to decide on their own. Whether we still want to have an anonymous medium of exchange between us, whether all our transactions should be monitored or recorded, even then for small amounts. This is the kind of question that the technology forces us to consider. And I would say the sooner, the better. Of course, there are arguments about financial stability, the risk of destabilization of bank deposit. We can discuss that in the further discussion. I don't think they are absolutely overwhelming. I think they can be dealt with. Now, to conclude on the pessimism versus optimism, should we think that the system will only change incrementally, or are we going to have a sort of big upheaval and revolution? I would say, I don't know. I think the pessimistic scenario that Barry outlined and that Steve in a way outlined, with the banks adjusting and the new stable coins or digital currency making only very, very limited inroad, is a possible one. And again, it will a lot depend on regulation. Another scenario is equally possible. And since we are in a research network, which I welcome very much, I would say in a research perspective, both scenarios should be explored, and the policy reaction and policy responses to both should be kept in mind, because the truth is that we really don't know whether we are just at some incremental change or a beginning of a fundamental upheaval of our payments and monetary system. Thank you very much. Thank you.
Thank you very much, Jean-Pierre. So I think got a good amount of food for thought. Let me maybe reflect some questions that we saw coming through the platform. The first one pertained to Steve's presentations. The person asked, well, is it so clear that we would have a mass movement towards central bank issued currency, and that banks could easily prevent this by just basically offering a bit more protection on the account? Another question that was more, I guess, aimed at to Tara was to say, well, is the distinction between a token and account really such a clear one? That's also a point that Jean-Pierre alluded to, because after all, tokens have to be registered somewhere. And then the final one, I guess, was more to Barry on the skeptical aspect. We say, fine, but we already have systems of private payment that works and work big and works quite well at Alipay and WeChat. So even though it may not be obvious what they add, the fact is that they're being used quite a bit. So that would be the first one of questions, and I would propose that we go to in the same order that we had for the first presentations to answer this aspect, and also to give the panelists an opportunity to react to each other's contribution. So I'll give the floor to Steve.
Thanks again. Let me start by saying that I think that most of us, I think we are actually in remarkable agreement. But I will challenge Barry to be more skeptical than I am. Let me just make one comment about the issue of whether or not funds will go into central banks, and whether these things will be account-based or token-based, and whether it makes any difference. So first of all, I don't see a huge difference between account-based and token-based. If you're going to have a massive amount of this stuff, the central bank is not going to be really that willing to issue massive amounts of digital medium, of digital currency without having any sense of who's using it. And so I just don't see how they can avoid the anti-money laundering, anti-terrorist finance, anti-drug, human trafficking stuff if they start to issue this. And I think it is important to keep in mind that some central banks probably will be issuing a lot of this. If you don't have to have $100 bills, $100 bills are a pain. right? They have to be stored. They degrade. They can actually, you know, if they get wet, rats can eat them, stuff like that. I mean, this is literally what happens right there. And you also have people wanting to steal them. Yes, you can get hacked, but so just to give you some sense of the volume, which Tara was talking about, the quantity of US currency outstanding in the world has doubled in the last decade. And as she pointed out, the vast majority of that is outside of the country, and the vast majority of that is in $100 bills. So let's say the Federal Reserve starts issuing digital currency instead, and then anybody can get a hold of these tokens that wants them. Anybody in Iran or in Venezuela or in Central Africa or in Myanmar can get a hold of this stuff. It's going to be a massive amount of it. So I think the other thing that you want to think about in all of this is something that's a problem with things like Libra is what happens to countries that are not that stable. So I think that's a serious issue. As to whether or not, even in an account-based central bank digital currency, you'll see massive movements in. Imagine that there's that all of a sudden the probability of a financial crisis rises. There's a probability of stress goes up, and you're a treasurer trying to meet your payroll. And so you can't get insured deposits at a bank because you have millions and millions of dollars in deposits that you need. And all of a sudden somebody comes along and says, well, you know, they're going to pay you 1% at the central bank. I'll pay you 2%. Okay, so now for 1%, are you really going to go and risk losing access to your money because the bank might suspend convertibility? I just don't see it. So I think that I think that this would happen the next time that there's financial stress, and I think it's an extremely dangerous thing. And I don't see the difference between tokens and account-based, because I don't see the central bank allowing massive amounts of anonymous digital medium out there.
Thanks, Steve. Continue going around, we'll give the word to Tara.
Thanks very much. I would agree with Steve. There isn't a lot of difference between token-based and account-based in the sense that you still have a record of the ledger. But my point was more, and I'll go back to a couple of things that Steve said, but my point was more that, you know, we think about what a huge change in the world a central bank digital currency could make. And people are talking about, and so the BIS just released its updated survey about central bank digital currencies just a couple weeks ago, and found that actually more central banks this year versus last are thinking about research and even issuing something in the medium term. So we think this is going to be a huge sea change, but the fact is that there are some proposals and projects out there which aren't going to be a huge technological leap. That's all. It's going to be digital money like we already have, and they're just digitizing the serial number. So my point was more about it's the design that matters, and not necessarily whether it's account-based or token-based. So one of the biggest design issue, which Stephen was alluding to, is whether or not these digital currencies built on DLT are permissioned or permissionless. So Libra originally said that it would be a permissioned system, and so they allow the people into the system to be able to validate nodes. But then it could become in 5 years permissionless, which means that anybody can get on and anybody can validate. And that, in a lot of people's mind, is really one of the bigger policy issues. And I certainly don't see any central bank digital currency ever becoming completely permissionless, because you don't have any of the controls that Steve was just talking about with compliance and anti-money laundering, et cetera, et cetera. The other distinction I would make, I think that's more important than token-based and account-based, is between wholesale and retail. So there's a number of projects underway looking at token-based wholesale currencies, and this would be mainly for between institutions and to settle securities trades, et cetera, et cetera. And when you have conversations about these types of projects, it seems completely within the realm of this is commercial, these are commercial banks, and they understand what the rules and regulations, the rules of the road are. And this is something that maybe we could become comfortable with as policymakers and supervisors. But if you talk about a retail digital currency or stablecoin, and even think about that in the central bank digital currency space, that becomes then very difficult, at least for me, to understand how this could be accepted and widely used. And just you know, one thing that we don't think about or talk about very often is we actually have already some digital security purchasing sort of websites like Treasury Direct. Right now, you can go directly to Treasury Direct and you can buy US Treasuries. And you never own the treasuries in its paper form. It's all digital. It's all in an account that you create at the US Treasury. So we have already a lot of digital forms of money. I think just thinking, the point was again more about the design of the features of the new types of digital currency that we could be seeing. And then just one last point about rats eating $100 bills. So there's 100 different types of toxic chemicals that are used to print dollar bills, $100 bills, and so that would make a rat really sick.
All right, I guess that would be a pretty expensive way of rodent control. Barry, I don't know if you want to react.
Yeah, if I understood the question, it was how can I be skeptical about the digital financial revolution and non-central bank money, given that we see exponential growth of Alipay and PayPal and their competitors. The point is that Alipay and PayPal and their competitors run on central bank money, that's what you're transferring when you make a payment to a vendor through one of these services. Uber now requires me to put Uber Cash into my digital account. What is Uber Cash? It's central bank money that I transfer from my bank account or my credit card to Uber, which it in turn transfers that central bank money to its driver after I've taken a ride. So I'm not disputing that the financial world, the economic world is becoming increasingly digitized. I am, however, expressing skepticism about the rise of alternatives to central bank money.
Okay, thank you, Barry. Jean-Pierre?
Yeah, let me say that I'm neither skeptical nor enthusiastic. I just think I would like to stay open and try. And I think in general, in the kind of period we are, where we have a lot of technological changes opening everywhere, the good thing is to do science fiction. You have so doing a little bit of science fiction about money is helpful to see what kind of scenario are realistic or what kind of scenario are unrealistic. To mention the latest remark by Barry, I think there's something very deep about here, and technology is not going to change the big advantages and propriety of central bank money as the pillar of our monetary system. At least in those countries where the monetary regime is very well assured and stable. I think in countries which are naturally exposed to currency competitions, and there are quite a few of them, that may increase both the likeliness and the intensity of currency competition from the outside. And in those countries where the monetary regime is fragile, the incentive of the population and the residents to start using a foreign unit of account may be enhanced by their ability to use foreign currencies as means of payment through digitalization. So I think the main point that Barry has made is absolutely right, but with the nuances of this increased currency competition for some countries. And that's not totally a coincidence in my view that the countries which are most interested in creating their pilot and exploring the possibilities of central bank digital currencies are emerging economies. So you mentioned Uruguay, which launched a pilot, and it seems to me emerging economies have a much more positive attitude to that than big currency area like the dollar and the euro. If I'm not taking too much time, I would like to react to what Steve just said. I think Steve said two things. He said first, central banks will not issue unlimited amount of their currency in whatever form without knowing who held it and what's done with it. And I think he's absolutely right on that. So this is clearly not going to happen, whatever the form, whether it's account-based or token-based. But then he made a point which I think is theoretically extremely interesting and what we should all be thinking very hard about. If I oversimplify what he said, at the moment, what keeps us for overusing the currency are physical friction. So it's costly to pile up $100 bills. They may be eaten or not by rats, but it has cost, it has risk. So basically, if I try to sort of conceptualize it, maybe a little bit oversimplify what he said we have convertibility of our private money into currency, but that convertibility is impeded by financial friction, right? Physical friction, sorry. And once those physical friction disappear, the situation becomes very complicated. And I agree with that. But I'm not sure that the solution to that is to suppress the convertibility from private to public money. So, because then we are getting into a very kind of different situation. So for me, this is a major conceptual and research issue. And I don't see any other outcome to that dilemma than to issue some form of central bank digital currency under the conditions that Steve has mentioned. But the moment we cannot rely upon physical friction to sort of make it more difficult to exert our right to convert private money into public money, then we are facing that kind of dilemma. And we have to accept that technology will make it less and less likely that we use physical cash as a means of payments. That's there. We can delay them, not very much. So we are facing that dilemma. And my question to Steve would be, what do we do when we don't have the physical friction and risk attached to the holding of currency?
Okay, thank you. We'll ask Antonio if you want also to put some questions to our panelists.
Yeah, I was going to raise a question which comes to some of the things that, I mean, all the panelists have been mentioning. I'm going to the skeptical view of Barry. I mean, it is correct that central banks remain at the center of the issuance of money and payments. That even in the case of Alipay and WeChat, sort of central banks are the ultimate place where payments are being done. But it's not clear that that's the only potential outcome. We can imagine outcomes which are very different. One could imagine two things, that we all end up having an account at WeChat, and then our payments don't go to the central bank. So the central bank becomes marginal. So these guys become monopolies of payments. But we can also imagine a private institution becoming a clearinghouse for all the payments. So they are the one holding the ultimate form of money through which settlements are done. And going to Steve's point, maybe the government has an account in that private institution, so I don't need to use the central bank to pay the government. I can pay them straight from a private institution. Now, of course, whether this happens or not depends on regulation. Do we allow these things to happen? Do we regulate them the way we regulate banks, where we require them to have an account at the central bank and a minimum amount of reserves? But what if we don't? What if we let projects like Libra, not quite Libra, but projects that look like Libra within just one currency, where they're holding assets which are not at the central bank, they're holding government bonds, and they issue liquidity that can be used by others, that is completely independent from central bank. And as long as we create an ecosystem of private institutions, that will be digital money unlinked to central bank. Now, is that completely impossible? I think that might not change the unit of account. The unit of account will be the same, but I think it will change fundamentally the way we think about payments and the financial system. And I don't know whether Steve, Jean-Pierre, or Barry want to answer my question.
I'm happy to try. I think completely impossible is different from highly unlikely. I think it's highly unlikely because of the compliance problems, because of the issue of financial stability risks, that if something like Libra designed better were to emerge focused on the payment sphere, wouldn't be long before Libra-related derivatives and a whole ecosystem of Libra-related financial assets and liabilities grew up, and that would create a whole host of issues for financial stability and regulation and so forth. I think alternative means of payment that are floating relative to central bank money are going to be undesirable to people whose expenditures are linked to, are denominated in terms of central bank money, whose salary income every week is denominated in terms of central bank money. And finally, there are the compliance issues with which Steve started an hour ago. So I don't think it's inconceivable that all of those problems could be surmounted. I think it's highly unlikely, however.
This is Steve. Let me echo several things I think that Barry has said in his earlier comments, and that is, well, so first of all, I think, Antonio, what you described is a system that we already have, which is to say we have huge ecosystems, clearinghouses, which where there are large internal accounts, and there are internal transfers. I mean, that's how chips works. There are payment systems. Some of them are retail, some of them are wholesale, but netting is on the central bank balance sheet, and finality is on the central bank balance sheet. And so the fact that the Bank of America has 60 million retail customers, which I realize by Chinese standards is small, but it means that in the United States, the Bank of America has huge fraction of on-us transactions. They're already doing it. And there are clearinghouse systems that already do it, but the ultimate settlement is on the central bank balance sheet. And so this brings up, I think, the issue as to whether or not, you mentioned whether or not the central bank would itself or the government have an account at one of these places. If the government stops insisting that that final payment and settlement of transactions with the government be on some other balance, be on the central bank's balance. Right now they insist it's on the central bank's balance sheet. If they started allowing it or just, offering it elsewhere, then I think the game changes. If any, I think there might be some small countries that allow payment of taxes, or some places in Bitcoin. I think this kind of thing is like, this is crazy, why you would do something like that. Not only because of the volatility, but because of the things that, you're just deciding you don't want the seniorage revenue anymore. You don't want to control finality. You don't want to. You're not going to worry about the legality of the medium of exchange. That just seems to me to be something I hope nobody in a real country ever does.
Can I say something?
Go ahead.
Yeah, go ahead.
Yes, I think this is a very interesting discussion. I think the central bank money can do three things actually. It can serve as the ultimate settlement instrument, and that's the function that Steve just emphasized. And I'm not as optimistic as he is about this being a permanent and assured for the future, because we can very well think of systems where you can settle technically without without any or minimal recourse to central bank money. So this may not be the function which will assure the centrality of base money in the future. The second function, which I think Barry mentioned and which is much more robust for the future, is a sort of lender of last resort function. And Barry said something which is very important, which is once you've created a new currency like Libra, it's only a matter of time before a big financial activity develops on the basis of this currency. And big financial activity means one way or another maturity transformation. And then when you have maturity transformation, the system cannot survive without a lender of last resort. And I think that's a very, very strong argument for saying that much stronger than the means of settlement, than saying that the central bank money will still be necessary in any kind of financial system. And again, I make that statement, maybe it's true, maybe it's not true, but that would be a very important area of research in my view. And third, of course, it's a unit of account. So if the central bank money is not the unit of account anymore, then we don't have a single currency anymore, and then we are in the situation that Antonio sort of described for the future. So I'm less optimistic than Steve that the central bank money will stay as a mean of as the ultimate settlement. I think it's much more likely that they will evolve more and more to be the ultimate liquidity provider in a complex financial system. And that is what maybe keep them at the center of the game for the future, whatever the technology.
This is Tara.
Yeah,
go ahead. Let me add just a quick comment to that very, very good discussion. I like to think about the central bank roles in 4 functions, actually, and we've covered all of them except one. So the first one's a unit of account, providing the currency, central bank currency. The second one we've had a good discussion on, and that's being the operator. So it provides a settlement finality, lender of last resort, and I think that's a very, very important role. We've had a good discussion on that. The other 2 roles are in oversight. So in order to have a smooth functioning payment system, we need to have strong oversight. And one could argue that the private sector probably doesn't have the incentives for a robust oversight of its payment system. So I just wanted to raise that as another consideration. And then finally, we like to think also of the central bank having a role as a catalyst, so being a catalyst for change and bringing people together. And so, yeah, just wanted to raise those other 2 functions. And one other comment that, that we've been thinking about a little bit, and that is, if we actually do move to digital currencies and we no longer have the physical currency, I wonder how that changes people's view of currency. And like, do people understand what a dollar is or a euro is anymore if they actually don't see the physical currency? And is that something that we should consider? That's all. Thanks.
Thank you. Antonio, I don't know if you have a point you want to make.
I was going to raise a question that somebody has raised on the Q&A, which I also wanted to ask. I was going to start asking this question to Barry. I mean, some central banks, in particular, Mark Carney at the Bank of England a few months ago mentioned the possibility of sort of central banks coming together and creating a global, I mean, whatever you want to call it, global stable coin, global digital currency, something that could resemble maybe the SDR to facilitate global payments. And that takes us back to a long discussion that we've had over many, many years about what should be the international currency of the world and whether we should have a supranational currency. Now, is this a debate that is becoming more interesting because of technology, or this is the same debate that we've always had?
I'm not sure the current debate is fundamentally different. So I think what Mark Carney had in mind was a digital analog to the SDR, as you said, that would be used for commercial transactions as well as transactions among governments themselves. Commercializing the SDR hasn't happened, despite arguments that some kind of basket-based unit for cross-border payments would be preferable to the current dollar-dominated system. If there really was a demand for this basket-based unit, JP Morgan and other private sector participants would already be issuing bonds and opening accounts denominated in such a basket. So I think this is very much the debate that we've had for a long time about why something like the SDR is not used more widely in the private sector with a slight digital twist on top.
Okay. Let me maybe put two question observations to our panelists. So we had a lot of discussion of whether central banks should and shouldn't go into this business. But do they really have a choice in the sense, if we have a private sector player that's going to go ahead anyway and likely not do it the way we would like it to do, can central banks still consider the status quo as an option, or do you have to choose between two situations, like let's call it the Libra and the other is CBDC, that you may not like very much either of them, but one of them would be a lesser evil? The second question I would like to put is, how different is this from a point of view of emerging economies? Because from advanced economies perspective, so we have a well-functioning payment system. Central banks have been doing a good job at keeping inflation low. If anything, they cannot get inflation to pick up again. So there's not much of a threat from bright money. However, and that was a point that was already mentioned, there's some countries where financial stability is not so clear, or the institutional structure of central bank may not be as good as a one advanced economy, even though many emerging markets have very good central bank. And for this country, couldn't the digital currency effectively dollarize them or liberalize them or whatever the word will be, and they lose their own currency with the usual benefits of shock absorbers. And we end up in a world that goes into a global currency to a large extent without really wanting it. So I'd be curious to hear your reaction on these two questions. Do central banks really have a choice? And how is this looking from the point of view of emerging markets, and what can we do about it?
You want me to comment on that, Cédric? Yeah. So on your first point, I think you can always repress technology to some point. And my guess is that people who are thinking right now about what to do with Libra are exactly considering this kind of trade-off. But I think on the medium and long run, you are absolutely right. It would be totally counterproductive for monetary and regulatory authority to try to prevent a technological movement, which by itself has a lot of benefits. I mean, we talked about cross-border payments. In the last 2 years, since all these cryptocurrencies became more or less popular and mediatized, you have seen many initiatives for improving the efficiency of cross-border payments, which I suspect would not have happened otherwise. Like SWIFT has announced a new global initiative, CLS has announced new protocols for making foreign exchange easier to implement. So for me, it's really the test case. If I were teaching or working in a business school, I would make that perfectly business case, because the simple threat of competition has totally changed the landscape. And that's the reason why, in my view, ultimately the authorities will not want to repress technology too much. And then they will face exactly the same dilemma that Cédric just mentioned. they will have to adjust, or they will have to give up part of their role in the monetary system. And in my view, giving that part of their role would mean that the central bank money may lose part of its function as unit of account, and that would be extremely dangerous. And again, this is the core case, in my view, for issuing a central bank digital currency. You have to issue money in the forms that people want to use. You cannot constrain for the long run the forms of money that people want to use in a market economy. That is sort of basic assumption, I think, that one has to make. And if people want to use money in digital form, the only question is whether it will be totally private or partly private and partly public. That would be my answer to your first question. And your second question, yes, I think we wrote a column with Marcus Brunnermeier and Harold Jones on digital currency areas. And we thought, again, it was a little bit of a science fiction exercise, but we could see a situation where some of the big operators you mentioned, whether they are Ant Financial or Alipay or PayPal or Libra, if it sees the day, they will extend their reach far beyond their borders. And providing a very convenient means of payment, their role may progressively creep in and force and induce people to start counting in different currencies as their own. And as you said, Cédric, it will, without even realizing it, sanction the appearance of new currency. So I think Barry may be right. Maybe not the synthetic new currency may not be coming, although we should keep open about that possibility. But a change in the technical underpinnings of global currency competition might be there. Yes.
I think that I make a couple of points. First of all, on the emerging markets, I think that's exactly right. But I would extend the argument that you made, or the way what was buried in your question, Cédric. And I would say that if the United States, if the Federal Reserve were to issue digital currency that became easy for everyone in the world to hold, the same thing will happen. Now, as for the SDR question, that I guess I didn't talk about it. I didn't mention anything about this before. The SDR question, which I think that Jean-Pierre just touched on, and what Barry said. I mean, there's another issue with that, and that is, let me ask you personally, Cédric, or any of the people listening, how would you feel about holding SDR in order to make purchases of your consumption basket, rather than the currency in which the consumption basket is actually denominated when you have to go and pay? I mean, that's fine. I mean, you might be able to get hedged and stuff like that, but why would anybody ever switch to this? Now, I guess maybe if the idea is that we're all supposed to switch, that's fine. But that brings up the question of how it is that you jumpstart this system and get everyone to shift. As for the first question you asked, which is sort of the biggest one, and the one where Jean-Pierre commented on, the question of whether or not the central banks of the world face a choice between issuing their own digital currency or issuing or letting Mark Zuckerberg do it. I guess I'm not sure I quite see the choice there. I mean, if Mark Zuckerberg wants to open banks in every jurisdiction of the world, there's actually nothing to stop him. And if he then wants to create a system whereby internally he has relatively cheap transfers between deposit holders in his now what would be, I don't know, 200 different banks around the world, I have no problem with that in principle either. I mean, he's going to be doing all the compliance, and so that's fine. It's going to be expensive. It'll cost a couple of % of assets every year for him to do it, but I don't have any inherent problem with that. But that's where I think that the that the authorities need to insist that if somebody issues something like that, and that they want to cross jurisdictions with it, that the licensing, chartering, and compliance all be met by all of that. Because again, I mean, and this is another thing about, there was a comment, one person made a comment about payments. I think that, you know, cross-border payments were too expensive, but where cross-border payments have been cheaper is where there's a bank at either end doing the compliance. Cross-border payments are always going to be expensive if somebody walks in to a money transfer operator's office with a pile of paper banknotes, hands it to them, and then wants those paper banknotes turned into other paper banknotes at the other end. Because now you have to figure out who these people are, and you have to, I mean, Western Union has huge compliance costs as a consequence that aren't disappearing because of the desire to ensure that we're not laundering money. I went on too long. Thanks.
Can I jump in? Although I was going to keep quiet until the end, but you know, your question, Steve, why on earth would you ever hold currency, which is a basket, in order to make payments in your own currency, in your own unit of account, which may be quite a stable one? So let's think of, you know, the US or Europe. Would there be a use case for making payments? And this is exactly the question that actually Antonio and I were looking at when we try to sort of come up with a ballpark answer of what it would require in terms of your risk aversity and how much money you would have to actually hold in order to make the payment. So the velocity of money, and you know, when you make reasonable assumptions about those, it turns out that the proposition of holding a basket is not an impossible one. It would seem absolutely, you know, that the answer to that is no, you would never hold it. But the answer seems to be that it's not impossible. Or in other words, the inefficiencies in the system are so large that technologically more advanced system may actually be viable even as a means of payment inside countries, let alone cross borders, which is, you know, the prime use case. I don't know, Antonio, if you want to add to that, since it was our joint work there.
Yeah, I mean, I think, I mean, I can see Steve's point, which is adding a unit of account always adds volatility and make it difficult to make it successful. But I think it's a question of trade-offs. It's a question of trade-off against transaction costs. Now we're talking about transaction costs going down and so like banking transfers costs going down, but there's still some large inefficiencies, in particular in the US, where sort of the involvement of credit card companies, which are sort of central to the payment system, still makes it one of the most expensive payment system in advanced economies. So you could imagine innovations that might involve some volatility and some other costs that could one day be successful. There's also a question of how much of the currency you have to hold. There's a lot of people around the world who go shopping in Amazon in the US. The price is denominated in dollars, but when you pay in your own currency. So you're not exposed to volatility. I mean, you're exposed in the sense that the price that you're gonna pay might vary over time. So I'm not sure a month from now how much I will pay for that good. But once I'm facing the purchase, I have zero volatility. So I'm paying in my currency and the unit of account is different, and that works very well. So again, I'm not sure it's completely possible. I understand maybe for the majority of people sitting in the US, which is a country which maybe is less open to some of these transactions, this is less of a possibility. But when you leave the US, this seems to be things that you see often either in a smaller scale or in larger scales.
Tara or Barry, if you want to add something.
I have just a comment to add. Barry, do you have something that you'd like to add?
Well, only that, again, when I pay my bill at a hotel in a foreign country, I am sometimes asked whether I want to pay in the local currency or pay in dollars. But that's different from asking me to choose between the local currency and a basket-based unit. I think the that alternative would look very different and very much less desirable.
Yeah, Tara?
Just a comment on whether we have to choose between a CBDC and Libra. I'd like to suggest that there may be a middle road, which is simply improving the current payment system that we have using new technology. So when we think about the technology that we've been talking about is a token-based plus DLT smart contract, sort of all in one bundle to talk about a digital money. But there are plenty of applications for DLT removed from a token-based currency. So you could think about using DLT, for example, in a financial institution to do better AML CFT compliance. And in fact, some of the very largest banks are starting to use DLT and AI to do better anti-money laundering compliance. So if we can think about using the new technologies to make our payment systems faster, and we're doing that, to make them interoperable, which would make cross-border payments much more seamless and less expensive, and to make them more transparent, which is what Swift GPI is doing by having this tracker that goes across the whole payment chain. So you can see sort of like tracking your FedEx or DHL where your payment is, and these things go very quickly. So I'm only suggesting we can improve current payment systems without necessarily having to go down the road of either Libra or CBDCs. But again, there's lots of work to do in that area if we were to think about that option.
Thank you. Let me maybe take one of the questions that we saw in the Q&A, going back to the point of competition. So there's a cost that if you have a payment intermediary that gets a dominant position and start charging with it, the charge may not be directly paid by the consumer, it may be paid by the merchant, but ultimately it shows up in the price. And then there's always an issue in any payment system, but is it more of an issue now? And I would add also an extra twist to that. Is there a risk that the relative weight of the regulator and the private entity could become unbalanced? Because if we have something that there's a national payment system and a national regulator, we have a rough balance of power. But if you start having a more global system, could it outpace the ability of the regulator to follow? Here I'd make a bit of a parallel with what we saw in banking in the euro area, where bank went euro area wide, but the regulator took some time to catch up, and it took the crisis and the transfer of power to the ECB to set things right again. So is there a risk that an entity could become too big to regulate, or could we find a way of more coordination among international regulators?
Well, this is sometimes referred to as the bloodhounds and greyhounds problem in financial circles, that the private sector greyhounds run very fast and the regulatory bloodhounds have trouble keeping up. So that's always been a risk. So to harp on my theme of the day, I don't see how it's fundamentally different now. Probably the best real-world example of this is Alipay, which is very innovative and very big, and has just been forced to clear its transactions through the People's Bank of China. So in that case, I think the risk was real that the payments were all going to migrate into the private sector, and the regulator responded forcefully.
Yeah, thanks, Barry. Any other, Antonio, or any other panelists want to jump in?
Well, I think you asked a BIS question, because
Yeah.
you asked a question about international standard setting, cooperation and collaboration, which I think we already know about these problems. I mean, the reason that we need banking regulatory standards is to ensure that it is to ensure that things within countries work, but the reason that we want global standards is to make sure that that cross-border transactions that people don't have to be quite so concerned, because it is the case that countries monitor the creditworthiness of their bank's cross-border counterparties by looking and ensuring that the regulatory frameworks in those countries are up to the standards. And so I think that we already have systems in place in the Basel Committee, in the CPMI, where I think Tara's sitting right now, in the International Association of Insurance Supervisors, deposit insurers, IOSCO, all this stuff. All this stuff exists in order to ensure that that what you're describing, Cédric, is actually sort of there. Now, as for something becoming too big to regulate, again, so long as operation in a particular jurisdiction is requires a legal entity in that jurisdiction, to be a problem. If you allow global entities, then you run into the problems that we have with taxation, where you have, you know, people operating in tax havens and the like. And you know, it could be that Facebook decides that it's gonna manage to somehow run something out of the Cayman Islands that's global. I guess Calibra is actually in Switzerland, and so it becomes a problem for FINMA. But ultimately, I think it depends on regulators and supervisors insisting that people operating in their jurisdictions also have legal entities that are regulated and supervised there.
Well, sitting in Basel, I'll just add a quick comment onto Steve's. I mean, I absolutely agree with everything he said. There are standard setting bodies, and this was a point I made earlier. There are standard setting bodies for financial institutions, that'd be the Basel Committee, for payment systems, CPMI, for insurance, IAIS, and for securities markets, because some of these digital monies could be considered under securities market regulation, and that's IOSCO. The biggest challenge, agree with everything that Steve said, the biggest challenge though is that if you think about one of these stablecoins becoming global in scope and scale, then they're doing all sorts of economic functions that are outside of any one given standard setting body. And so the coordination role becomes a little bit more difficult. So we know how to handle a systemically important payment system. We know how to handle a systemically important bank. We don't know how to handle a systemically important quasi-payment system that has an e-wallet sitting in the US, but is governed out of Switzerland, and that's being used in Peru. And so there will be some coordination issues. The international community is thinking really hard about this. There's no panacea, but it will need to be addressed on the both cross-sectoral and cross-border perspective. And then there's two additional issues which are kind of outside of how we normally think about financial regulation issues. And that's issues of competition, because if a Libra actually does operate, we've got some competition policy issues to think about. And then data privacy protection and ownership would be another issue to wrap into the whole, basically what would need to be a very large supervisory college.
I'll just make one comment that I thought, and Jean-Pierre will remember this, that we created the Financial Stability Board to ensure exactly the coordination across different entities that you're describing. So hopefully that's working. Maybe it's still has some difficulties and growing pains, but that's where that should happen, I guess, is my reaction.
Well, Steve, just having been as an invited academic to the FSB group that meets on this last week, and who is going to deliver a report to the G20, you know, my impression is that there is still a long way to go, because what Tara just mentioned, that, you know, you have it is a different quality than what we are used to. It's not just a home host issue. So if a global stable coin emerges and it is regulated, say in the US under securities laws, say in Switzerland as whatever they call it, let's say it's a type of ETF, and in another place it is regulated as an e-money, and yet it is being used globally, and there is not much you can actually do to prevent it. Then I think the quality of the issue is different, and it doesn't even have to be a multi-currency global stablecoin. It could just be a successful one from any country. So let me sort of, you know, throw that question back at you again. You know, is the regulator really up to it? We all agree that regulation will be extremely important in what goes forward, but can regulation actually, you know, be fast enough here and coordinated enough? And the second question that I wanted to pick up from the feed that we got is, China seems to be quite advanced in the thinking and also in the preparations for a digital currency, which might, you know, again, of course there are capital control issues there, but, you know, it might be used cross borders too, at least regionally. How to think about those? You know, if any of the panelists want to comment.
Maybe on the regulatory issue, Steve mentioned our common past, and it seems to me that the first thing the regulators should really think about is what they want to achieve. They have trade-offs, right? Do they want those stable coins to compete efficiently or not with the payment systems operated by banks or not? And I think you can make it both ways. You can argue it one way or another. But it seems to me that it's not clear right now what is the objective function of regulators. And so the risk is that they start regulating without really knowing what they want. And this is a period, I mean, this is kind of really circumstances where identifying the trade-offs, making coordinated choices would go a long way in terms of finding the proper balance. And the natural reaction, and I saw that when I was looking at cryptocurrencies a year and a half ago, the natural reaction of regulators, and that's natural, it's normal, is they try to attach those new objects to categories they know already, right? And that makes them feel safe, and that gives them a natural framework of reference. And then the problem boils down, of course, as you said, that it all depends which category you pick up. But I would suggest, and maybe this is the usefulness of what we are discussing here, I would suggest that the role of academics and researchers and all of us is to try to identify the trade-offs and ask regulators what they want to achieve. If you're only thinking in terms of efficiency and cost of payments, and we know that the banks are making tens of billions of dollars of revenue out of payment system. If you think only in terms of efficiency of payment, the case is very strong for allowing Alipay, PayPal, any kind of new Libra to compete freely with banks. If you're thinking in terms of overall financial stability, the distribution of credit, the protection of privacy, the efficiency of anti-terrorist financing fight, the case is more nuanced. So I would say it's very important that the regulator identify their objectives, whether they want to attach those new entities to a kind of bank-like regime, and this is kind of Stephen alluded to, we can ask them to be banks and regulated like banks, whether they want to accept them as a new actors with a new form in the system, and they cannot avoid that. And if they regulate without doing that, I think they are going to be totally behind the curve permanently. They have an opportunity to do that, and I think they should do it.
Thank you. before we continue there, I'm going to have to leave because of scheduling constraints, but Beatrice and Antonio are going to keep steering this debate. I just wanted to say thank you to all of you for what was a very active and I think very interesting discussion, and wish you a good weekend.
Thank you, Cédric, for hosting us here. Let me, give Antonio a chance to ask, maybe one last question. We have about 15 minutes left in this debate. One last question or comment you would like to do to the panelists, and then I think we do one last round and see if we can also address some of the questions that have been coming in through the Q&A and the feed. Antonio, over to you.
Yeah, I was going to ask a question. I mean, even if we take that pessimistic view that some of these stable coins or new forms of digital money are not going to replace in any way the current currencies and the role of central banks, a lot of the things we're discussing are going to pose a challenge to the banking system. If you look at banks, in particular in some regions in Europe, their profitability is much lower than it used to be. Now in the US, that's not as strong as it is in Europe, partly because interest rates have been slightly higher as opposed to Europe. So the yield curve has been slightly steeper, partly maybe because of competitive issues. But some of these new technologies and new forms of payments are sort of moving the action away from banks, certainly the revenues and the profits. Again, I wonder whether that's a source of concern which is much bigger than what we've discussed so far. I tend towards these forms of payments, technology, fintech and big tech could disrupt the financial system and create either instability or a world that looks very different from what it does today.
I think that's right. And there are plenty of historical precedents or analogies to look to. An example would be the rise of the corporate bond market in the 1970s and 1980s, which caused a lot of the commercial banks' big corporate customers to migrate away from using the banks for finance. And that process did not go smoothly. It contributed to the banking crisis in Japan as the banks responded, how should one put it, less than optimally. So clearly clearing cross-border payments and a variety of related lines of business are profitable for the banks, and those sources of fee income are almost certain to decline. And intelligent bank managers and regulators need to worry about that and worry about how to respond.
I'll make two comments. First of all, I think nobody picked up on the China question, and I think that I have questions about that, in fact, and that is, yes, I understand that there's a digital yuan being issued by the People's Bank of China, but China, it is my casual impression that China's privacy concerns are a bit different from what they are elsewhere, and that China's financial system is not as competitive as elsewhere. And so I think that those are being issued in a very, very different environment than the one that, and then of course, Beatrice mentioned the capital controls. So you put all of those things together, lower concerns about privacy, basically large state-owned banking system and capital controls. And I'm not sure it's an example that really helps us to understand what would happen elsewhere. I guess I'll just stop with that and let other people comment on the other questions.
Nobody else wants to chip in on China? I mean, it would also be possibly something that is used across borders, not only within China.
That's right, but I think in a strictly regulated way. So the manner in which China deals with cross-border issues is incrementally look to the qualified foreign investor programs that they've rolled out over the last 10 plus years. Institutions are qualified to do portfolio investment across China's border and into the country one by one as they negotiate with the relevant authorities in China. And I think that would similarly be the case as China continues to digitize its currency. It will tell the Central Bank of Cambodia, which is rapidly moving down that same road, that they can clear transactions digitally between the two. It will tell HSBC at some stage that it can do cross-border transactions using the digital renminbi, but that's very different from saying to everybody, okay, go for it.
Thanks, Barry. Are there any sort of last comments that the panelists want to make, picking up either on comments from others or other thoughts? Maybe can I start? Oh yeah, jump in.
Yes.
Jean-Pierre.
Yeah, just about what Antonio said. I think for the banks, the possibility that it's a real disruptive evolution is, I think, real. The conventional wisdom is that the main functions of the bank are being sort of unbundled by the technological progress, with payments on one side, credit, intermediation, all separated. And the thing we said in our paper with Marcus and Harold is that most likely the payment function will become the central function. Such as credit or asset management will become sort of auxiliary to payments. And the reason why is that because payments is the place where people, if those big networks develop, payments are the place where the customer interaction with customer will take place, where the data will be collected together with other data coming from social networks or social activities or e-commerce activities. And then once you have the data, you score, you can do credit very well. You can have a bank as a balance sheet to locate your credit, but it's only a balance sheet anymore. And the central industry, the central nexus of financial intermediation will be the payment. That, in my view, is a potential scenario. And I think if the banks want to adapt that, I think they can adapt to that, as Steve has said at the beginning. But if they adapt to that, if they want to, they have to rethink their role in the payment system in a sort of rather dramatic way.
I agree with what with Jean-Pierre just said. I think that payments and information are going to be critically important. I do think we may end up having data custodians who are actually separate entities. But let me just make one observation about what I see around me, at least here. And that is, I see all these fintech startups doing a variety of things, not just payments, but a variety of things. And a variety of things that serve various aspects of the financial system. And most of the startups view as their objective to be purchased by an existing financial institution. So the idea here is that, what banks are doing is they're allowing other people to innovate, and then they're buying them, and they're integrating the activity into their current thing. Now that's of course causing the banks to be different from what they were, but they still exist. This is my comment about Monte dei Paschi, right? And that is that it's not identical to what it was in the 15th century, but it still exists as a bank. And so I think that that's what we're going to see, is we'll see evolutions where a lot of the innovations that we're talking about are going to be integrated into the systems that the banks have today, hopefully making them more efficient and hopefully benefiting the bank's customers, which is something that as Thomas Philippon has taught us, they have not done in the last 150 years. But thank you very much. This has been really interesting.
Thank you, Steve. Tara, any last words from you?
Yeah, just 2 points. In the Geneva report, we actually make a similar point to what Steve did, and that is we think the banks are actually not going to die a slow death, that there is still plenty of life left in them. And we did a survey, a qualitative survey as well, and the banks are really transforming the way they're thinking about technology. It's true they're buying fintech companies, but they're also doing a lot of in-house investment on IT, on artificial intelligence, machine learning, et cetera, et cetera. So they're trying to transform themselves given the competition in front of them. And then the last point I'd make is we kind of jumped in between, there's either CBDC or there's a Libra, and I made that point earlier, but I think we are going to see a transition that is going to be a little bumpy along the way, but that is going to involve needing to interoperate between different types of technologies, different types of systems. We're going to, for example, the Bank of England is updating its RTGS system, trying to think about how it can become interoperable for a token-based currency while it's still in its account-based world. So we're going to see a spectrum of different designs and a long transition period and maybe some bumps in the road.
Thanks, Tara. Antonio, do you want to say a few words on this debate or on any other thoughts you have?
I just wanted to thank everyone for the participation in the debate. I'm glad that we found a time to put people together across time zones, which span 16 hours. Some of us are going to bed right now, while Barry must be having his breakfast. So it was a pleasure having this conversation with all of you.
Well, that is something I was also going to say. Thank you so much to the people who got up early and those who are staying up early, meaning Barry and Antonio and everybody else here in between. But let me also thank the participants. So we've had a great participation all along these 2 hours. We've had quite a number of questions. We managed to address some of them in general terms, but not all of them. So I would encourage both the panelists and those who raised the questions to please follow up if you feel that we were not able to answer the questions. Well, then it's definitely that we have not been able to answer all questions. So the one constant in as an academic, what you say in the end is, we need further research. But we don't only need more further research, we also need policy, we also need coordination among policymakers and regulators, as we have observed. And we also are in a world, in which things are moving fast. My impression is that, the Libra project is still very much alive, and they're trying to work down the lists of requirements that have been set by regulators already. And if it's not Libra, something else may very well come along. And central banks and regulators better be ready for it. I'm not, going to try and do justice to this rich debate, summarizing it, but definitely we've had a spectrum of views. Although, these are all economists, the spectrum ranging from probably, I would now put Steve and Barry, and having a hard time to say who of you is more skeptical, but he was definitely very skeptical. And then, I had Tara somewhere in the middle, and Jean-Pierre actually is the person who is talking about, science fiction. Let's be open to science fiction. Let's think about alternative scenarios because they may materialize more quickly than you think. So my last words on this is it works. This first experiment of a webinar, if you have great participants like yourself, great panelists, it does seem to work. You can have a meaningful interaction and discussion. And the good thing is that we can watch it again. It's not gone. And we can hopefully build on it in future webinars at CEPR. Thank you so much to all of you, and have a good night or good day or whatever. Bye bye.
Bye.